Anybody can pay off debt if that's what they choose to do. What I would like to show you is how you can pay off your debt and get the money back. I've done it. Let's talk it through. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's life lesson, we're going to be discussing leveraging liabilities. Now, this is from a series where I normally can use this in question and answer series virtually or in person when I'm addressing groups on the infinite banking concept. So this is going to be some of my best practices, some of my own personal experience, of course, how I professionally help folks understand and implement the infinite banking concept with scale and a greater level. It's based from R. Nelson Nash's book, Becoming Your Own Banker. And the idea here is to liberate the layman from laborious loans. Okay, so not just paying off debt, but paying off debt and getting the money back. This is debt recapture. The life lesson, leveraging liabilities. Now, again, the book from R. Nelson Nash, Becoming Your Own Banker, I read it in 2015. When I read that book and I realized that I was the average American that Nash was talking about, my wife and I, we had the student loans, we had the car note, we had the credit cards, we just had that great all-American spread that he mentioned in his book. It was a financial paradigm shift for me. It was an aha moment. It was unplugging from the matrix. It was getting a brand new perspective on this paradigm of you becoming your own banker. You being able to have the control and the profitability of banking in your life. So I'd encourage you to read R. Nelson Nash's book, Becoming Your Own Banker, if you haven't yet. So this is a snapshot. This is us. So for those that are just tuning in, I'll describe it to you again. We had student loans, we had credit cards, we had the car note, we just had all kinds of things, and it was almost $50,000 worth. And if you're tuning in on YouTube or anywhere else where you can see this information, I'm just laying out our debt sheet for you here. But we had about $50,000 worth of debts. Now, because of Nash's book and being exposed to some of the human problems that he enumerates in this book, I realized that, well, a big part of our problem, of course, was our behavior. We had overlooked Parkinson's law. Now, Parkinson said that most people tend to spend what they earn. Okay, and if you earn more, you tend to spend more. That's just a natural human tendency that we have. And it can become a problem, of course, if you're not living within your means. So Parkinson's law was something that we needed to address. But then there was a problem also. We had financed all these different things in life without knowing, without looking at, and it's because we were born into this current commercial financial paradigm of banking being in the hands of other folks. We've abdicated that to others, that responsibility, and therefore the profitability, which means we were bleeding out interest dollars to those institutions. Now, Nash in his book, he lays it out this way, that the average American is paying about 34.5% in interest alone from every dollar that he earns. And he's very conservative in how he approaches this. He says that, you know, if he gives 10% of someone's income to them in savings, if he just gives them the credit, essentially, for saving 10%, they'd still be paying about 34.5% in interest, which means that if you're not saving 10%, then you're probably paying more in interest. Well, there's a certain amount that goes to autos. There's a 20%. If, again, for those that are just tuning in, the average American, he said, pays 20% in autos, 30% in housing, 40% in living, which is your vacations, your charitable giving, your lifestyle, such as it is. And again, if he credits you with saving 10%, which I believe is generous based on current data, current data shows that it's less than that for the average American. But still, you'd be paying about 34.5% in interest. So yes, we had some behavior issues that we needed to address. Also, we realized that there was this massive problem of interest that we were just bleeding out for the things that we were financing in life to the tune of about 35%. And again, folks, take just a moment and realize that furthered education is financed. Vacations are financed. Our automobiles are financed. Our recreational equipment, business equipment, weddings, our homes. Again, those campers that we have, the lawn care equipment, airplanes. I know there are those of you out there, okay, and with your airplanes, and any remodeling that we're doing on our homes, reconstruction, additions that we're building on homes, motorcycles. I mean, fill in the blank. At the end of the day, everything is financed. That was a revelation to me, that everything was financed. And we're going to walk through that. In fact, there are two ways of conventional finance. And the first being credit that we will address, and the next being cash. So everything is financed, and I do mean everything, folks. And we're going to walk that through, because either we are using credit or cash. Now, if you'll notice, and here I'm giving a visual for everyone that is tuning in, for everybody else that's not, here's the description. The baseline is zero. Remember that. The baseline for both of these ways of financing is zero. The first scenario of using credit looks like this. Well, you've got to apply, right? You've got to ask somebody permission to use their money. You got to fill out their paperwork. You got to see if you qualify, and you're going to submit yourself to their terms and conditions. Of course, you may be providing collateral, but if they approve you and they give it to you, at the end of the day, you go into debt. Now, if you go into debt for one thing, we'll talk about cars here in a second, probably. It's very often that debt is not even paid off all the way before it's renewed, it's refinanced, you get another one, okay? I mean, just go to any car dealership and ask the folks working there how many of the cars that are brought back aren't even fully paid off before that individual is getting their next vehicle. So that means that there's going to be a compounding on your debts perpetually. But either way, whether it's the credit cards, whether it's the cars, the homes, the vacations, the visual is we go into this hole below zero. Remember, zero is the baseline. And we slowly, in making payments, and remember that interest, you've got to remember that interest, but all the other variables as well. The terms and conditions that we're submitting ourselves to, subjecting ourselves to, the collateral that we may be putting up, our homes. There's a stark realization. The risk that we're assuming, who enjoys the ownership and control of this scenario. But the idea is to build up to zero. Okay? Now think about that. Well, we'll get to it again. The second scenario is to pay cash for everything. I know there are those folks out there, cash is king, pay cash for everything that you do. Okay, so here's the other scenario. You do that. You set aside money somewhere. It is a good thing to consider where you're setting aside money for all those same reasons. Okay, but you do set aside money somewhere. That takes time. You may be assuming some risk. You should ask yourself, well, what kind of access do I have to this capital of mine? Do I have any guarantees that it'll be there, that it won't diminish, etc.? Am I going to experience growth? And if I do experience growth, do I have to pay taxes on that growth? Am I doing anything to account for inflation? Is this easy to manage? Are there penalties? Are there fees? Am I giving a true cost to my capital while I'm amassing it here for the things that I want to do in life? All relevant questions to ask about this way of financing things. And I'll bet that the vast majority of y'all, my cash is king folks, you've never thought that you were financing things, but you are. Look, time is still lapsing for you to save up enough for the things that you want to do. And your money does have a cost to it. There's a cost to that capital. If you're a Bible scholar and this interests you, I encourage you to check out the parable of the talents in Matthew chapter 25. 3 folks were given 3 different amounts of money, and the ending result was very interesting. I'd encourage you to check that out, particularly the guy that decided to put it in a hole in the ground. But look at this. At the end of the day, if this is the method that you're using, yes, you need to answer all those questions that we addressed. But at the end of the day, when you save up enough for the thing that you want to finance, because you financed it, every time you set aside money, to save up for it, that's essentially a payment. You're financing this, okay? Either we're paying interest to somebody or forfeiting the opportunity to earn interest. But at the end of the day, when you buy that thing, you're back at the baseline. The good news at the end of this is, sure, you didn't pay interest to someone else. You lost the opportunity to earn interest, though. But furthermore, your principal is depleted. It's liquidated. You're back to the baseline. If you need to replace that car or that whatever thing, you've got to start back over again. You're at zero. So at the end of the day, credit and cash, these two conventional ways of financing, bring us back to zero. We're either digging out of a hole or we're having to build up, and it liquidates down to zero. The ending result still puts us back at zero. Now, those are the two ways of financing, credit and cash. I know there are lots of voices who will help folks or encourage folks or say, do it this way in getting out of debt. They'll say things like eat beans and rice. Of course, the debt snowball. I was on the phone with a client the other day, or a prospective client. No prospective client. I was on the phone the other day with a prospective client, and we were walking through what debt recapture looks like. And they said to me, well, Jesse, this sounds like a debt snowball. And I said, well, it is. But the difference is we're not just snowballing the debts out of your life. We're recapturing that principal, interest, and profitability that had been going to those folks. Now that can stay in your own privatized banking system. So in getting out of debt and having that gazelle being chased by a lion mentality, that's all great. I can appreciate that. The way to get out of debt and get the money back is infinite banking. There is a third way to finance things. You don't have to pay interest to other people. And you don't have to lose the opportunity to earn interest on your money. This third way is what we implemented. In 2016, our first policy went in force. We made our first policy loan in 2016, and we began recapturing, not just paying these things off, but recapturing the interest dollars that we had been paying, and we snowballed this. But that was snowballed back into this private banking entity of ours. Now, when it comes to debts, I've already said that everything is finance. We need to recognize that debt also is finance. And I love this quote from Nash when he said, your need for finance is much greater than your need of protection. Again, if you've not read Becoming Your Own Banker, I'm going to encourage you to read his first book, Becoming Your Own Banker. He also has a second book called Building Your Warehouse of Wealth. And there are other great resources out there as well. But when I read this book, and I realized that we did want to make these changes to our behaviors, Parkinson's law and such. We recognized the problem of how we were bleeding out interest dollars. We decided to pay off those debts, but we decided to do it the infinite banking way. And that simply meant that we added one step. Okay, so we didn't change our cash flows. We didn't have to work any harder. We didn't lose control. And we didn't take any additional risk. We added one step to the debt snowball, which was building up this private asset of ours. Okay, we paid premiums to a properly structured whole life policy with a mutual company that paid dividends. And then we leveraged the cash value from that policy to pay off the debts that we wanted to pay off. But because we'd paid premiums into the policy, that meant that our capital was compounding, and it also meant that we could use it because we owned this private appreciating asset to pay off the debts. But then that allowed us to recapture the interest that had been going to the other people back here. And I know that, and that's why we have these life lessons and all of the other series on our podcast and channel. I know that folks have this conventional concept of whole life insurance as, well, that's just for when I kick the bucket. That's just for having a guaranteed windfall, sure, for my beneficiaries, just to accommodate that risk. I understand that, and it has that use. It has that application, to be sure. But again, there are plenty of detractors out there, and I'll just say, vet this concept for yourself. That's why I encourage you to read the book. Of course, I've got an introductory presentation on our website and channel that just introduces you comprehensively to the infinite banking concept. And then we've got tons of series. We've got a Q&A series. We've got a client interview series. We've got famous financial quotes. We've got financial quick takes. We've got our encyclopedia series where we're covering the vernacular, we're covering the vocabulary of infinite banking and whole life insurance, and we're giving definitions. And so there are just tons of resources. We've got a series on the myths, mysteries, and misconceptions surrounding infinite banking, because the fact is that, just like Will Rogers says here in this quote, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. And that is where so many of us are. Sure, a lot of us don't know what we don't know, but many of us think we know something, and it's just not so. So again, why whole life insurance that's been structured for infinite banking with a mutual company that pays dividends? Well, in fact, there are more than a dozen characteristics that make a properly structured policy the ideal asset for privatizing your banking. In fact, those characteristics are such as, Jesse, insert that funny little clippity clip here with the voices and the thing. Yeah, do it.
Transferability, guaranteed growth, liquidity, tax-deferred and tax-free benefits, protection against volatility in the market, litigation protection, inflation protection. It's easy to manage. There are no hidden fees or penalties. It's reputable. It's safe. It is consistent. It is permanent. There is private ownership. There is control. There is guaranteed growth. And there is a highly respectable anticipation of a dividend.
So there are several properties that make this entity the ideal asset. Now, that means that a whole life insurance policy does have a death benefit, a guaranteed death benefit, to be sure. I'm going to call this a leaving benefit, but also, and the purpose of this series of life lessons is to point out the living benefits of properly structured policies with mutual companies that pay dividends. There are several of them. The one that we're covering today is going to be leveraging liabilities. It's at the bottom left here, recapturing debt. Okay, it's how to recapture debt, not just pay debt off, but recapture debt. And are there living and leaving benefits, okay, in owning and using a whole life policy to do something like recapturing debt during your lifetime? Oh, yes. You can do it. We've done it. I'll show you how. And in the event of your passing, whenever that is, does that leave you with a tax-free windfall to your beneficiaries to account for any, remaining outstanding debts that you have? Yes, it sure does. They would have a tax-free windfall to square away any outstanding debts that you still have if you've been properly structured and adequately insured with your whole life policy and any other pertinent policies to that point. So let's go through this thought process of your money, banking, recapturing debt. Let's talk through this. Who controls the banking function in your life right now? You might be vetting this concept still, and you are either realizing that you're in that credit camp, or you're realizing that you're in that cash camp. Okay, and you're seeing this new way. You don't have to pay interest to other people on their terms and conditions. You front collateral. Also, you don't have to relinquish your opportunity to earn interest on your capital or put yourself at risk. And you can account for inflation and offset that and all kinds of things in that camp. You're realizing that there's this third way of compounding. Okay, and you can do that through reacquiring the banking function in your life, reacquiring the responsibility and the profitability of accounting for the banking function in your life. Conventionally, we're doing that with the banks out in the commercial world. What I'm saying is you could take your cash flows, your income, such as you have. You could add that one step, just like my wife and I did, paid off tens of thousands of dollars worth of debt by first deciding an appropriate amount of premium for us to pay into a properly structured whole life policy with a mutual company that pays dividends. Those premiums forever compound in a whole life policy. I'm saying it again, those premiums forever compound in a whole life policy. Yes, they do acquire you a guaranteed death benefit, okay, tax-free windfall to your heirs, beneficiaries, yes. But because it's been properly structured, this policy, you're going to have a cash value in the very first year that you can use right away, just like we did. And when I say right away, I mean within 30 days of a policy going in force, you could be leveraging your cash values just like we did to begin tackling whatever it happens to be in your life. I know in this life lesson, we're covering recapturing debt. So within 30 days of our policy going in force, we were making a policy loan and we were paying off credit cards and moving through our debt snowball, recapturing capital back into this private banking system, this private banking entity. We leveraged our cash value. That's grown. Again, folks, we've been doing this now for the better part of a decade at the time of this recording, 2023. We've been doing this for the better part of a decade. We own several policies at this point, several policies with different companies. Love them all. And that cash value has done nothing but go up. It's guaranteed to go up. Every premium dollar that you pay, that grows your death benefit, that grows your cash value. And because you have that cash value, you can leverage it. You can access capital. This is your private entity. This is your private appreciating, self-collateralizing asset for your use. Okay, so for your recapturing debt. So you can pay a debt off, recapture that principal and interest back into your private banking system. And here's a snapshot of my wife and I. You know, we got that first policy in 2016. I'm laying out a timeline for you. 2017, 2018, 2019, 2020. Here's the first 5 years of us implementing the infinite banking concept, of us, yes, getting that first policy and beginning to conquer debt, but we lived life along the way also. Okay, we took family vacations. We did take advantage of some opportunities. We did finance a family wedding. We did do some remodeling in our home. Thousands of dollars went into a home remodel in these first 5 years. And we acquired 3 policies in these first 5 years. We paid a pretty significant amount of premium for us relative to us. And right at the end, actually, in 2020, we were able to get policies on each of our children, making our total 6 policies. So 6 policies right at the end of 5 years of implementing this concept. And we paid off credit cards. We paid off all of our student loans. We paid off our car. I mean, we have no mortgage on our home. We financed an anniversary trip. My wife and I, we've always loved and enjoyed doing that. We finance our property taxes through this infinite banking system of ours, some business equipment. I mean, there's just a lot of things here. I'm saying a lot of this out loud for those that are just tuning in to the audio, of course, but just realize that a lot of life happened. Even though we started wanting to pay off debt, we did want to do other things as a family and as a marriage, you know, trips, property, opportunities, all different kinds of things happened within our family, and some things happened outside. Maybe y'all heard about, you know, there being a pandemic. We had some career changes during this time. I started up a business. I entered the professional space of mentoring and coaching and writing business for folks that are looking to implement the infinite banking concept. I went from being just a consumer myself to being a professional in somebody else's corner, and now I work all across the country, which is pretty cool, helping folks all across the country do the exact same thing. But that's a snapshot of what the first 5 years looked like for us. We did it. And I do want to say that you can too. We realized that if we applied these principles, that if we used this ideal product, it could create a whole new paradigm for us, okay, of being our own banker. Whole new paradigm. So we implemented that process. And we did pay off the credit cards. We have no student loans today. We've paid off that car. We have no mortgage on our home. Our net worth is bigger than ever. I mean, that death benefit just keeps going up. The cash value just keeps going up. Weekends, holidays, it doesn't matter. Dividends, we've earned dividends on all of these policies, of course, because you own policies with companies. You should own policies with companies that have paid dividends for over 100 consecutive years. And you use these policies for the things that you're already doing in life. We already had $50,000 worth of debt when we learned about infinite banking. We just realized that we could go about paying that debt off and recapturing it. We realized that we didn't have to go the credit way of financing. We didn't have to go the cash only way of financing, but that we could experience the control, the ease of management, and the profitability of compounding within a private banking entity. And my encouragement to you, of course, is ask what questions you have. If there's something you'd like me to address, of course, you can put it in the comments section here. But what I would encourage you to do is to check out our free introductory presentation on our website, durhamtalents.com. Also, I've got my calendar link where you and I can walk through your questions, your concerns, your goals, your aspirations, what it could look like for you to implement the infinite banking concept in your household or your business or your investing. Whether it's recapturing debt or anything else, we can walk through that scenario. I do encourage you to check out Nelson's book, Becoming Your Own Banker. And this has been a great pleasure for me. I do look forward to our next conversation, and I hope you have a great day leveraging liabilities. Take care.